Welcome back to Entrepreneur Money Stories. Are you trying to better understand your business's financial health, but still feeling overwhelmed by how complex and confusing traditional accountants and accounting systems can be? In this video, I'm going to break down the essential components of a healthy, profitable business and how you can use your balance sheet to better understand your financial health. Hello, everyone, and welcome back. My name is Danielle. I have Victoria on the show with me today. And I am not just an accountant who's helped thousands of business owners over the last decade, but I am also a business owner who is looking at the same information for my business, Kickstart Accounting Inc., as you are. So today, I'm going to share with you all of my tried and true tips for looking at the balance sheet and creating a healthy business that you will be able to use for years into the future.
I am so excited for this episode, Danielle. I feel like the balance sheet is one of those or can be one of those big mysteries in accounting that a lot of people have trouble understanding. I'm super excited. I know you have some great client stories to share, so let's jump in.
All right. Yeah, you're excited for the balance sheet, and I'm excited for the cash flow statement. So, all right. So, just a little bit of a recap. We have three financial statements. It's the income statement, which is the flow in and out of your business. We have the balance sheet, which shows you a picture of the business, a statement in time that shows you the health of your business. The balance sheet is a tool in your toolbox that shows you the statement of worth of your business. So it tells you exactly how much your business is worth. And then we have the cash flow statement. So I heard an example of the balance sheet and how the balance sheet can help business owners kind of uncover more about their business and the health of their business. So I heard this analogy. Yeah, ladies, you started dating this guy, right? And he is amazing. And I did experience this as well. He brings you flowers all the time and takes you out to these dinners, and you are just wowed by how much of the showering that you receive during this time of dating. What is that called? Courting? The courting of dating, right? And then as you get more serious with this individual, maybe you guys are getting engaged, and you start to take a look under the hood and you get a little bit deeper and you start asking some questions and you realize that this person doesn't actually own anything, right? They don't have any cash in their bank account. They're renting, they don't own their house. They, actually had their car, foreclosed on, and they lost their car. They have a ton of debt, and they have a pretty unhealthy behind the scenes story. And so I think the same thing when it comes to the balance sheet for businesses is it tells the actual health of the business. The income statement is like the dating season. And you might be spending money within your business, but then the balance sheet is going to tell you how bad is your spending.
That is a great analogy. I've never thought of it that way, but that is one, as a woman, that's a little scary to think about. I'm sure as a business owner, it's also really scary to think about that you can think that you're doing so great. You have a ton of sales, you think you're doing great. And then at the end of the day, your business isn't actually healthy.
Yeah, we hear from clients all the time. You keep telling me that I'm profitable. Where is my cash going? Like, why don't I have any cash in my bank account? And this balance sheet helps us understand that story. So, the balance sheet can be used for two big things to determine the health of your business and the health and the worth of your business. And then it also can be used to know if your balance sheet is correct. I think this is one place where when we bring on new clients to Kickstart Accounting, when they're going through the onboarding process and we're doing that cleanup where we're looking at their books, getting everything cleaned up and set up and ready, where we see that clients, and this is always news that's hard to deliver, when clients have come in, they were doing their own bookkeeping and they thought they were doing a great job. And then we get to the balance sheet and it is a complete disaster. So if you are doing DIY bookkeeping, remember, it's not just about your income statement. The balance sheet has to be accurate. And a lot of those errors, they're being hidden onto the balance sheet.
So, Danielle, what do we even look at? We're opening up our balance sheet. We're not sure. What do we look at?
I'm going to start at a high level, and then I'm going to tell you what most accountants will talk about and why we're not going to go into much detail there today. At a high level, right? Like just let's take it up 30,000 feet view. The balance sheet includes three areas. And I think that the accounting terms is what makes it confusing. So our first category is our assets. These are the things that we own, and we can have short-term assets and long-term assets. Short-term assets are things like cash, money that our clients owe us. Those are two very good examples of what we see with our clients. If you go and look at a large company, or you're starting to invest and you're looking at companies on the stock exchange, their balance sheet is going to look very different than a typical small business owner. And so I want to be clear, what we're talking about today is the small business owner's balance sheet. You don't have a lot of those cash equivalents. So CDs, high yield savings accounts, things that can be liquid in your business. Ignore all those things that I just said because it's not applicable to you, right? I just said a bunch of accounting terms, like stop. Then we have our long-term assets. Our long-term assets are things like equipment, buildings, large purchases. It might be things like your computers, those larger purchases. Does that make sense?
Yeah. So how do you determine if something that you purchase should go on the balance sheet as an asset?
Usually, so for us at Kickstart, we use a threshold that if you're making a purchase that's over $1,500 or more, we'll consider putting it on the balance sheet. If it's less than that, even if it is a computer, but it's $1,000, expense it. It's not worth putting on the balance sheet and then having your tax accountant depreciate it over time. It's a small purchase ultimately. And so those we put directly onto the income statement as an operating expense. So we're talking larger purchases. You are buying, $10,000 worth of equipment, talking to you photographers, or, you're buying a large building, venue owners, right? Like you're opening up a second location and you are doing a lot of leasehold improvements. You are going in and improving a space, a building, and you are spending a lot of money, right? And whatever a lot of money is for your business, that might be $5,000 that you are using to improve your space, but you need to be spending a significant amount of money. Anything under that $1,500 threshold, let's put it to the income statement. We don't need to confuse the issue. So next we have liabilities. Liabilities are what you owe to other people. So usually for our clients, online business owners, this looks like credit card debt. So under your short-term liabilities would be your credit card debt. So what is the amount that you owe on your next statement or within the next few statements, right? You might be paying it over time, but it's still a short-term loan. Here we'll also see payroll liabilities. So if you have not moved over to Gusto, or you're using the old school QuickBooks process where they are only debiting the payroll taxes at the end of each quarter, you will have a payroll tax liability sitting on that you owe that money, right? Like the payroll company didn't take that cash from your checking account and isn't holding on to it for you. They left it in your checking account. And now you're responsible for holding on to that cash and paying it at the end of the quarter. This will also include sales tax. So if you are charging sales tax throughout the month and throughout the quarter, and then you owe at the end of the quarter or every 6 months at the end of the year, you will also have those liabilities. So you collected sales tax from your customer and you now owe that sales tax to the authorities. That will sit as a liability. So money you owe to other people.
Yeah. So it's easy to think about your liabilities just as anything that you owe money on.
Yes. Now, where accountants like to make it difficult is that there's short and long term, right? So just like there's short and long term assets, there's short term and long term liabilities. Long term liabilities, I think the best example I can use is the SBA loans during COVID. A lot of our online business owners went and received SBA loans, and they have a very long time to pay them back. And so when you have a long time to pay something back, more than 1 year, it'll sit as a long-term liability. So those long-term loans.
Why does that matter?
Because this is the health of your business. If you have more in debt than you have in assets, and that you have in sales, you might not have the cash to be able to stay in business. That's one of the biggest issues that we see. And I'm going to say one of, because we will talk about the other ones, that a client is bringing in profit, but because they're holding on to credit card debt, long-term debt, because they owe money, sales tax, right, payroll taxes, because that cash management, they can never get ahead because those profits are always going back to pay the debts of the business, reducing the debt or fulfilling those debt obligations. Our last section is our equity. Again, I'm not going to confuse this issue for you guys and with all the accountant jargon. I'm going to keep this simple. Equity is where if you invest money into your business as a business owner, that's going to show up in your equity. We're all just going to ignore my dogs barking in the background. I don't know how much they're going to edit that out, but we're just going to ignore them. That means I spent money in the Amazon deliveries here. Equity is also your owner's draws. So anytime you take money out of your business, not through payroll, that is an equity. And so this is the value of your business. When I talked about that the balance sheet is your scorecard, it's the valuation of your business, I really mean that. Because if you don't have profit and you're taking out a lot of money in personal expenses and draws, in your equity section, when a banker, investor, a purchaser, an acquisition comes in to look at your business, they're going to look at that equity section and they're going to say, whoa, there's not enough profits. They're taking out too much equity from their business. And so this is your value scorecard in your equity section.
Yeah, I also want to point out, and this goes a little bit back to the income statement and, what goes on the balance sheet, what goes on the income statement. And something that we have run into recently with clients who become S Corps, now you have to pay yourself a salary. So it can look different from year to year. And when that salary now goes onto the income statement and you're used to seeing it on the balance sheet as draws, that can really change the perspective on your business.
Oh, we are seeing this so much this year. People who became S Corps, and I'm so excited that they're becoming S Corps. There's a huge tax advantage to that. Once you pay yourself a reasonable compensation, that's why we offer the reasonable compensation tool in our business as part of our suite of offering, is because once you have that reasonable compensation document from our toolbox, you can then take as much draws as you want in your business. It's going to show up in equity, right? It's not like it's a free card. It's still going to show up somewhere, but you then can find that balance between salary and draws.
Yeah, I think that's a good point, that it's not just, a free pass to take money out of your business to take an owner's draw, and that it is recorded somewhere. It does show up on your balance sheet, and that is somewhere that they will look if you are selling your business or you're getting a valuation done. It is still looked at.
I think a big piece of, you asked, why is this important? The assets and then the liabilities kind of sit as these two separate, you can almost think of them as not a piggy bank, but like two sacks, right? Like two sacks, maybe two sacks of marbles or coins. And you don't want more, right? You don't want one sack to be bigger than the other. So you don't want to have more in the borrowed side than you have in the saving side. And you really don't want to have too much in the saving side either, right? Because if you are just always saving more money in your business, then we probably need to address your money mindset and talk about why we're not releasing those funds. Why are we not taking draws, bonuses? Why we're not reinvesting back into the business? That's why we created the Money Mindset Mastery program. It's because we're seeing way too many of our clients holding on to all of their dollars and creating an inequality between the saving and the borrowed coin bags.
Yeah. This whole series is back to the basics, and maybe we should have led with this, but the whole reason it's called a balance sheet is because of the accounting equation. If we're going back to like my high school accounting class, like that's one of the first things that you learn. And so it really is a balancing act and getting that ratio of equity and liabilities right.
Have you heard yourself saying, I'm scared to invest money in my business because what if it doesn't come back? I don't know how much to pay myself, so I won't take a paycheck yet. I'm reinvesting in the business anyway. Or how about, I'm not going to spend any more money until I know exactly where my money is going. Well, let me tell you, you are not alone. In fact, we have heard all of these stories and more throughout the last 9 years at Kickstart Accounting Inc. And that is why we have created the Money Mindset Mastery Framework to finally unlock and overcome these stories, to finally feel confident in your financial decisions and pay yourself what you deserve. The first step to create a profitable and successful business is to first understand your money mindset. Find out your money mindset personality type by going to kickstartaccountinginc.com/quiz. I can't wait to hear what your money mindset type is. You had talked about the balancing act, and I want to be clear that what you're talking about there is the balancing act in managing your business. So, are you managing your business with too much cash and not enough debt, or too much debt and not enough cash, right? Like, what is the balancing act between your spending habits, your reinvestment in the business, how you're paying yourself? That's the balancing act that you and I are talking about. Traditional accountants, so I want to talk about what traditional accountants look at when they're looking at the balance sheet. Usually what accountants are worried about is that the balance sheet balances. And so it's a very technical term, and that your assets have to match your liabilities and your equity. But QuickBooks does this for you. You don't have to, as a business owner, worry about, does my balance sheet balance? You don't ever have to actually think that thought, because you are not doing journal entries in your business. And if you are, for the love of God, please do not ever do a journal entry again. Talk to your tax accountant or your bookkeeper, because you should not be doing journal entries in QuickBooks. And therefore, you don't need to worry about this balancing act. The balance sheet will balance in your accounting system. Does that make sense?
Yes. And that is a very important difference between, the actual balancing of the balance sheet and the balancing act of running your business.
Yeah, yes. And you know what? You and I naturally, we are very specific in that what we do is called management accounting, right? We are not CFOs. We're not out here giving you strategy, consulting, looking at the strategic direction of your business. We are helping you use your numbers to manage your business. And that is the balancing act that we are looking at. The bookkeeping is a vehicle to be able to help you be able to manage your business. So I wanted to make sure that was super, super clear. The other places where I hear accountants talk about the balance sheet a lot is accounts receivable and inventory and accounts payable. And we specifically skipped over those things. So I don't want you to think, why did they talk about it? They're missing pieces. We don't see that being applicable to most of our clients. So most of our clients in the online space are running cash basis businesses. I don't want to go too far into this on whether or not it's cash or accrual. We've done a podcast episode on this before, and we might do another one in the future. But most of our clients are running cash basis financials, meaning when the income, when the sales, when the cash comes in, you are considering that sales or revenue. So cash hits your checking account, it becomes revenue or sales. The day the money leaves your checking account, it is considered an expense. And so our clients are running mostly cash basis businesses. Therefore, they're generally not doing invoicing and accounts receivable. So if you are somebody who is doing invoicing and your clients don't pay by the end of the month, your accounts receivable or money they owe you would be one of your assets. And same with accounts payable. If you are a business who is receiving invoices and bills from your vendors and then paying them at some time in the future, you might have accounts payable. We see most of our clients paying for expenses on their credit cards, through their debit cards. They're not processing that traditional accounts payable invoice and then paying it 30 days later.
So I'm assuming that your advice there would again be to talk to your accountant to see what is right for your business, because that is something that is very dependent on your business.
I don't want you to talk to your tax accountant only. I want you to talk to your money team. So we had a client several years ago who was working with a tax accountant who was doing both their bookkeeping and their taxes. This tax accountant had them flip from cash basis to accrual because it was going to save them $20,000 in their taxes. However, it caused major issues in their bookkeeping and major issues in how they manage their business. And they had to switch back the next year, and they still owed $20,000. So no matter what, the tax accountant was just passing the buck. It was just moving it to another year. And that really wasn't the best strategy for this client, because guess when they had the cash? That year. They had the cash to pay the cash bill in that year. But the tax accountant's only priority was to save in taxes this year, right? Tax accountant's only job is to file your tax return and to maybe save you money on your taxes. They are not thinking holistically. They're not thinking strategically. They're not taking into consideration how you manage your business and how you're doing your bookkeeping. And so I do not want you to have the conversation with just your tax accountant. I want you to talk to your bookkeeper and your tax accountant to make sure that they are in sync and that you're doing the right decision to manage your business.
We say a lot when we talk about tax strategies to reduce your tax liabilities. So that doesn't mean pushing off your taxes to the next year or doing things that might save a buck right now and then you're on the hook for it later.
All right, I want to land this with the few things that we look at on the balance sheet that you can take with you from here. So I mentioned that the balance sheet can be a place where you are looking to see if your books are being done accurately. And if you go back and listen to the income statement episode, we talked about over or understated sales. And you can find that error by looking at your on-deposited funds. So if you have on-deposited funds, traditionally that means something is in transit at the end of the month. So maybe you received the check from the client, but the cash didn't actually land in your account. Most of our online business owners, 90% of them, do not actually have undeposited funds in their business. And so if you have this account sitting there, I want you to talk to your money team about why you have undeposited funds. There might be a reason, but you need to understand it. Sales tax. So if you have a sales tax balance that is always accumulating and never being relieved, you probably have a bookkeeping issue. Is the sales tax going to the income statement? Are you not paying the sales tax? Are you not paying the full balance? Are you charging your clients too much? There's a myriad of reasons, but if your sales tax balance on your balance sheet is going up, there's a bookkeeping issue. If you have assets that are sitting on your balance sheet, but you don't actually own anything, you need to understand why there's assets sitting there. We had a client recently who came on board who she had all of these assets. And really what we figured out is that she just paid way too much in taxes last year because these weren't assets. She incorrectly categorized them. And so she used up those resources last year. They should have been an expense last year. And instead, she's doing her own bookkeeping. They landed as an asset, and she's going to get the tax benefit this year. But this is also a place where we're looking to see, are there any credit cards that are listed that are not being used? Do you have any personal expenses, personal credit cards, personal checking accounts that are sitting on the balance sheet that maybe you stopped using them, but there's still a balance sitting there? And if you have any personal accounts, both credit card and checking accounts, get them off of your QuickBooks. Your personal is your personal, your business is your business. We've talked about this so many times. We cannot continue to commingle. We have to have them separated. And so if you're seeing these old accounts on your balance sheet, this is a bookkeeping issue. And then the last one is personal expenses. Look, from time to time, it happens. I got a new credit card last month, and it was like a personal card. I had lost it. They sent me a new one. The chip doesn't work. Victor, I spent like 45 minutes at the gas station because I inserted the chip and my credit card wouldn't come back out. Right? When it finally came out, I went to the other side and I was like, well, it's got to be just a pump issue. So I went to the other side and it ate my credit card again. It was then declined like multiple other places. I was like, okay, there's a credit card issue. And so I had used my business credit card a few times. I share that story because one, like who gets their credit card eaten at the gas station? But also, it's not the end of the world, right? It happens. Fundamentally, mine are separate, but it will happen from time to time that you're using it. And so looking at your equity, because one of the issues that we see with clients is that they'll say to us, guys, you keep telling me that I'm profitable, but I have no cash. Well, when we look at it, they're commingling. They have a ton of personal expenses coming through their business. They're taking draws and they don't realize how much of the personal expenses are adding up because it feels like $100 here, $100 there. And we all know how that adds up.
And it does add up. And it's also something where I know I've heard it from the team 100 times of, business owners think that something could be a business expense and they're trying to expense it. And either the IRS guidelines have changed or it really just truly cannot be classified as a business expense. And so we have to put it to owner's draws.
Yeah. So talk to your money team, right? So make sure that for all of our clients, we offer a call. So if you're a client, book a call. If your money team isn't offering you a call, then find a new money team because you should be able to talk to your money team. So talk to your team and review your personal expenses. What do they have categorized as personal? What did you intend to be business? What did you intend to be personal? Have that conversation with them, because that is going to be one of the places that we can see a cash issue starting. And we'll talk about that more on our next podcast episode on how to read your cash flow statement, but understanding those personal expenses that are landing in equity. Do you feel like you have a better understanding of the balance sheet, Victoria?
I do. And I think it's more nuanced than the income statement, at least in my opinion, as far as like there's a lot more accounting terminology that goes into it and long term and short term. But I think one of my biggest takeaways is that this really highlights the problems with the DIY bookkeeping.
Absolutely. Yeah. Yeah. If you're doing your own bookkeeping, go look at your balance sheet. You'll be surprised to see, I think you'll be surprised to see what you see there. And yes, there's definitely more accounting terms, and I removed most of them. Like we really hardly even touched on any of them, and I did that very intentionally because there's so much accounting terminology when it comes to the balance sheet. So even if the short and the long term confused you, I want you to scale that even back further. It's either an asset or liability or an equity. And if that's confusing, think cash. What do I have in my pocket? Who owes me money? Liabilities. Who do I owe money to? Equity. What have I contributed to the business? What have I taken from the business? In this most simplest form, that is what the balance sheet is.
I know it's a very simplified version, but I really think that will clear things up for people, especially when we're talking about those little tips and what you can look at just to like get a handle on things. Sales tax, make sure you're paying it. Make sure all of your accounts are in there. I think we come across it a lot where you open a new credit card and either your bookkeeping team doesn't have it, it's not connected to your QuickBooks. So just occasionally, take a peek and make sure all of your accounts are there.
Yeah. And they're reconciled. So that I am going to throw out as an accounting term that all of you need to know. There is a feature in QuickBooks, and this is one of the reasons we continue to use QuickBooks over other softwares like Xero, FreshBooks, Wave, is that QuickBooks has a reconciliation feature. The reconciliation feature is ultimately a double check. It is the accountant's accounting way of saying, yes, everything has been accounted for, nothing is duplicated, because no matter what, these systems are freaking amazing, but there's flaws. I can't tell you how many times QuickBooks has duplicated expenses and brought in all the transactions twice. If you're not doing that reconciliation feature, you can really miss things. And this is dollars and cents. You are going to overpay on your taxes if you do not have the bookkeeping correct. So I don't say that to scare you, but I believe in responsibility. As business owners, we have a responsibility. And I don't care if you don't feel like you're a money person or numbers don't come easy to you. You started a business and it's your responsibility.
Yeah, absolutely.
All right. Don't forget to hit like and subscribe. I don't want you to miss the cash flow episode. That's going to be a good one. We have a ton of amazing guests coming onto the show. And if you need help, if you're not getting these reports or this level of support from your team, go to kickstartaccountinginc.com. We would love to be a resource for you. All right, Victoria, thank you for being here.
Thanks for having me.